Excited for break? No, we're not starting early. So, just going to review quickly what we did on Tuesday. And then we're going to continue to talk about revenue. I doubt we'll get through this today. I mean, best laid plans, you know what they say, right? And I don't like to rush through things that I know are going to come up later that you need to know now. So we started to look at special issues with recognizing revenue. So we started off just talking about what revenue is. Then we took a look at when we recognize revenue traditionally at a point in time or over a period of time. Those are basically our two options. And unfortunately, it doesn't stay as simple as that all the time. So then we started to look at some special issues. I did not cover all of them. I skipped around a little bit. I am going to cover some more of those today. We talked about what variable consideration meant. And variable consideration was when we weren't certain as to the amount of revenue we were going to get, or it was contingent upon or dependent upon something else happening. So we looked at a couple of scenarios. We did a couple of exercises at the end of class, and I think that's where we left off. Now, I know you guys had chapter 4 homework you turned in, but I would like to kind of get through the rest of what I want to get through here today. And so we already looked at these examples. I'm not going to spend any time doing that, but I think this is where we left off with another special issue with regards to revenue. So again, just to remind everyone, we're talking about revenue recognition, and recognition means when do I record it? So this is a complicated chapter. There's a lot in it. I was going to post the quiz today, but I didn't feel comfortable doing that until I got through some more of the information in the chapter. And I won't give homework over the break because then it's not a break, right? And so when we come back next Tuesday, we'll wrap up revenue recognition, and I'll post the quiz on Tuesday. It'll be due next Thursday. So we'll do it that way because nobody wants to do homework over break. So today we'll continue with these special issues, and then if I have some time left, at the end, I'm going to let you guys work on one of the cases, continue working on a target case, which isn't all that terribly hard. So, and that'll be a graded assignment for the chapter, and we'll wrap up. So also over the weekend, early next week, I'll be doing grades, midterm grades, so keep that in mind too. Okay, so another special issue is something called rate of return. This is something you've already dealt with at the 100 level, in your 100 level courses. People return things. That's just the way it is. A few years ago, the FASB made some new rules about this particular piece. So we never used to really record returns until they actually happened, but now you have to estimate what they might be. So I'm not gonna lie, that's kind of a pain because it's kind of hard to know who's going to be returning something in the future, right? And so you've got to estimate it. So, sales returns and allowances, you guys remember that account when you sold something to somebody and then they, returned something from a purchase. We had sales returns and allowances. So that's really what we're talking about here. The right to return goods and services. You guys have seen signs that say, final sale, right? No returns. No refunds, no returns, that's it, that you're done. You can't return it, right, no matter what. Most often you do have an opportunity to return. So this exists when the customer can return the good if it's not satisfied, or unable to resell it. There are stores that when you buy things, if you can't sell them on your shelves, you can return it to the vendor or the supplier from whom you purchased it. It is viewed now, and this is what's changed, this is now viewed as a failure to satisfy the original performance obligation. And as we know, we do report net sales revenue on the income statement, where we do sales less sales returns and allowances, but now we have to actually estimate those returns. So that can create some issues, obviously. Quick little example here, we're still going with True Tech. So let's see what we have here. This is pretty straightforward. Assume that True Tech sold 1,000 try boxes to Comp Store for $240 each. True Tech estimates that Comp Stores will return 5% of the try boxes purchased. Where does the 5% come from? Where do you think it comes from? I mean, we don't worry about it, it's given in the problem, but in real life, where does it come from?
Like data they've collected over sales.
Yeah, pretty much historical data, as I like to call it. Things that have happened, what typically happens in the past. And so this is how they'll report that, even though the sales returns haven't happened yet. Notice the word estimated in there, right? So sales revenue, 1,000 boxes at $240 each, less the 5% return, and that gives you net sales of $228. So that kind of also goes to the concept of being conservative. When we prepare our financial statements, we're supposed to be conservative with our values and our numbers. We don't want to make people outside of our organization think that we're doing better, or we're better off than we actually are. And so if you can't expect or anticipate returns in the future, you now have to show those on your income statement. Any questions with that? If it all was just this simple. So now we come into another issue with regards to principal or agent, and this one is not all that challenging either, and I'm going to explain it this way, and this is why your book explains it, and I would have explained, this is probably the easiest example. You guys are all familiar with real estate agents. Anybody have any real estate agents in their family? Nobody? Yes? Okay. So how does that work? Do you want to tell us how it works? Okay. All right. Then that's okay. So if I want to sell my house, right, and I don't know anything about selling houses, then I'm going to probably hire somebody to help me do that. Maybe I'm also looking for a house to buy. So I hire a real estate agent, right? They don't own my house though, do they? No, I own my house, but I'm going to pay them a what? I'm going to pay them a percentage of, I'm going to pay them we call it a commission, right? There's also, or you could use the term broker fee or something like that. But anyway, so who's the principal and who's the agent? That's the question that you'll be able to answer after we take a look at what each of these is. So the principal provides goods and services. They are vulnerable to risks associated with holding inventory. The agent facilitates the transaction between the principal and a customer. So who's the principal in my example? And who's the real estate agent? I'll give you a clue. One of them has the word in it. The real estate agent is the agent, and I would be the principal. I own the property, right? The agent is just making the fact that I want to sell my house known, right? Through whatever avenues that they use. So I'm the principal, they're the agent. So we have to decide how does revenue get recorded in by each of those individuals, right? So for the principal, they're going to record revenue equal to the total sales price that they received. So my revenue in my example, which I wouldn't be recording, but would be the price that I get for my house, right? Whatever I sell my house for. And you also would recognize cost of goods sold if you had cost of goods sold. I would not in that example. And then the agent's revenue would be the commission that they earn on the sale of the house. Average commission right now is about 6%. That's average. Don't yell at me if you think it's different. That's just the average. So we'll get, I'll look at an example here, again, continuing with Tribox. Mustafa buys a Tribox module, use normal names here, from an online retailer for $290. Let's consider accounting for that by two retailers, print company and age company. Oh, principal and agent, haha. Principal company purchases Tribox modules directly from TrueTech for $240, has the modules shipped to its distribution center in Kansas, and then ships individual modules to buyers when a sale is made. Principal company offers occasional price discounts according to its marketing strategy. Agency company serves as a web portal by which multiple game module manufacturers like TrueTech can offer their product for sale. The manufacturers ship directly to buyers when a sale is made. Agency company receives a $50 commission on each sale that occurs via its web portal. So again, pretty straightforward. The revenue, we talk about principal company, they buy online for $290, it costs them $240, so their gross profit is $50. Sales minus cost of goods sold, so they would have two journal entries. For agency, they just get a commission, basically, of $50. So they have revenue of $50, they do not have cost of goods sold if you're looking at those side by side. The net result is exactly the same, right? But again, two different roles and two different avenues of revenue stream, and you have to be specific about that when you're recording it. Hey, we're going to skip time value money. Anybody care? I gotta skip some of this stuff. No? No one cares? Oh, okay. Are you happy? You should be happy. Skipping time value money. I'm gonna skip that. Oh yeah, let's talk about, well, this one's pretty straightforward too. So another special issue, because there's lots of things that could kind of make you think outside of the simple recording of revenues that we talked about at the beginning of the chapter. So payments by the seller to the customer. If the seller purchases distinct goods or services from the customer, at the fair value of those goods and services, the seller accounts for that purchase as a separate transaction. If the seller purchases distinct goods or services from the customer, pays more than the fair value of those goods or services, these are viewed as excess payments, and they are treated like a refund. That's not something all that usual that happens, but it can. So, and then we have another one here when we allocate the transaction price to performance obligations. So we've got various ways to estimate, so what we call standalone prices. So sometimes you buy multiple products for one price. So it's like if you buy building, land, and equipment all for one price. You've got to allocate that one price to those individual components when you record them. It's kind of like students trying to lump, yesterday in my Accounting 101, we were doing closing entries, and a student tried to close expenses with one credit to just expenses, and instead of the individual expense accounts, because they all need closed individually, right? So it's kind of like that. You have to take that $1 amount and you got to divide it up over that which you're purchasing. So these are just some approaches to figuring out what those amounts might be. So how much would I record for the land, the building, the machinery, that kind of a thing. So you can use the adjusted market assessment approach. I've seen this where you look at the market price and you figure out the percentage. You do it by a percentage of the total price that you pay. And you can also do, it's called expected cost plus a margin approach. And so you know how people mark things up, obviously above cost, so that they make some money, right? So you're shooting for a specific profit margin in that case. And then residual approach is to subtract the sum of the known or the estimated standalone selling prices. So if you know what you would pay for each of those things separately, the land, the building, the equipment, then you subtract the sum of the known standalone prices from the total price you paid, and you would do an entry that way. So just some multiple approaches to figuring out amounts when you have a lump sum payment or purchase. You've got to divvy it up. And I'm going to actually skip the example here. Okay. And so then let's jump to licenses. So you guys have probably seen some of this stuff, just kind of on a simpler scale. So the last few things we're gonna talk about here, we'll do a couple of brief exercises to reinforce as well. But a license, so what's a license? You guys are gonna know what these are after we talk about them. So we've got really two types that we talk about here. We talk about functional intellectual property. That's going to be the first one here we discuss. And then on the next slide, we'll talk about symbolic intellectual property. So we want to make sure that we understand each of these, because these are pretty commonplace nowadays, especially after you see what these are. So a license allows the customer to access the seller's intellectual property. We call it IP for short. Licenses of functional intellectual property, and you do need to know the difference between the functional and the symbolic. But functional intellectual property transfers a right of use, so sellers typically recognize revenue at a point in time. And it's typically when you have access, at the point at which you have access and you can start using it. The simplest example I can give you, and it's up here, is a music download. You guys download music? You download it. If you're using iTunes, you got to sign in, log in, whatever, right? And then it downloads and you can play it. At that moment right there is when revenue should get recognized, okay? Couple of characteristics, I guess, that I'll call these. It has significant standalone functionality. can perform a function or a task or be played or aired. In other words, you don't really, I mean, it doesn't, you don't impact the owner of that intellectual property by playing that music or downloading that music, right? It's a standalone thing. So, you know, I talked about music. It can be other technology. It can be media. It can be entertainment, like pictures. You download a movie, watch a movie on TV, something like that. Trying to think, oh, books, if you guys download books at all, listen to books, you guys downloaded if you downloaded a textbook, at the moment you downloaded the textbook and had access to it, the publisher at that point in time should recognize revenue. Does that make sense? Okay. This is such exciting stuff. I can see all your excitement. All right, so we're gonna do an exercise after this one, so pay attention. Then we have symbolic intellectual property. This is a little different. This is going to be the opposite in terms of standalone functionality, okay? So other licenses provide customers with the right of access to the seller's IP with the understanding that the IP does not have significant standalone functionality. And so basically, the seller is going to undertake ongoing activities during the license period that benefit the customer, okay? The seller could make changes to the IP over that period of time, and it might affect the value of the license to the customer. So you can see up here, it lacks significant standalone functionality. The benefit the customer receives from the license is affected by the seller's ongoing activity. And so therefore, the license transfers just a right of access to the seller's IP. And some examples would include trademarks. What's a trademark? Trademark, trade name. Nobody has one on their article of clothing right now, do you? Yeah, so, you know, I don't, you know, pick whatever you guys are wearing, you know, if you decided, if you guys are entrepreneurial, you must make your own shoe or clothing line, can you use the Nike swoosh? No, you cannot. The McDonald arches, they're trademarked, right? What about trade names, brand names? Give me an example.
Usually it depends, but you usually can't at least use it like that industry.
So I can't, like, I'm not really allowed to, you guys listening, I'm not really allowed to make generic a brand name. So like, I hear people all the time say, I'm gonna go use the Xerox machine. It's not a Xerox machine. Xerox is the brand of photocopy machine. Now, there's no trademark police going to come and give you a fine for speaking like that or whatever, but you're technically not supposed to make generic a brand name. And people do it like tissues, right? Maybe it's an older generation thing, but you know, my grandma, I was talking about her earlier, she used to like to fold these bags. She used to say, I need a Kleenex. Right? Then she needs a tissue. Kleenex is the brand of tissues that she might have preferred, but right, you're not really supposed to do that. I mean, again, no one's going to come and get you in trouble for that, but what about a franchise? We'll talk about those actually here in a few minutes, but what's a franchise? Nobody? Sarah?
A company with a large corporate owner and then more are smaller subsidiaries of the same company owned by private individuals.
Yeah, okay, so what's the benefit to me buying a franchise? Why would I do that? I don't have to do my own marketing, which means I don't also have to do my own what? I don't have to, well, yeah, I would kind of put those two together. Do I have to come up with whatever product I'm gonna sell? I don't. Do I have to worry about establishing a customer base? Probably not, right? Do I have to worry about location if I already know which one I'm purchasing? None of those things. You go through training, you know, you already got the reputation to back you up. You know, now that's not free, right? There are franchise fees and they're pretty expensive, but it gives you the right to sell a product or a service that's already been well established, right? So notice it says recognize revenue over the license period. Okay, so remember, we either have at a point in time or over the period. Those are basically our two options for recognizing revenue. And you don't need to pay attention to the exception right now. I'm not worried about that one. So if you just understand that for licenses, we recognize revenue over time, for the most part. So let's take a look at an example of that, though, so we know what's happening here. So I'm going to switch over to my book, and let's take a look at page 318. You guys are going to do this brief exercise with me. How about that? Page 318, the very bottom of the page, the last brief exercise there, 624. All right, so those two PowerPoints that I just talked about are going to be super helpful in answering this particular question. So that's why we're doing it now. I'm like to slip in these brief exercises at kind of after each section. So SAR Associates sells 2 licenses to Kim and Company on September 1st, 2024. First, in exchange for $1,000, SAR provides Kim with a copy of its proprietary investment management software. Before I read any further, what does that mean? What's proprietary mean? It means what? Not sure that in that example. But I always appreciate. I agree. I appreciate it. No one else wants to answer. Nobody knows what proprietary. So we're just going to accept that we don't know what the word means and just move on and read the rest of the question. No, we are not. What does proprietary mean?
Proprietor mean like business owner?
Okay, you can start there if you want. Somebody Google it for crying out loud.
Like the first generation of something new.
First generation of something new? Okay, somebody Google proprietary for me, please.
Relating to an owner or ownership.
Yeah, right, it's pretty general, right? So, okay, so Ian was kind of on the right track, right? Investment management software, pretty much that management investment software, proprietary means that those folks invented that software. Proprietary software is basically a term, or anything proprietary is like it was self or internally developed, self-developed, okay, self-created. So anyway, so in other words, who made this software? SAR Associates did. It's their software. That's pretty much it in a nutshell. So it says, SAR provides Kim with a copy of its proprietary investment management software. So SAR developed this software, which SAR does not anticipate updating, hint, hint, and which Kim can use permanently, hint, hint. Second, in exchange for $90,000, SAR provides Kim with a 3-year right to market Kim's financial advisory services under the name of SAR Associates, which SAR advertises on an ongoing basis. How much revenue will SAR recognize in 2024 under this arrangement? I'm going to give you a tip here. One of those licenses is going to be your functional intellectual property, in which we recognize at a point in time. One of those, because you got 2 amounts there, is going to be your symbolic intellectual property, which gets recognized over a period of time. So I just gave you a couple big hints. So with that information, tell me what is what, which one's functional, which one's symbolic, and what's the total amount of revenue that can be recognized in 2024. I'm going to give you a couple of minutes to think about it. You guys can talk amongst yourselves. You got to start applying what you learn. If you need to look at those PowerPoints, you can do that. You guys have access to those. You can get your book or your laptop out if you need to. Which one's functional? Which one is symbolic? And how much revenue do we recognize? Functional, at a point in time. Symbolic, over a period of time. This is a crappy marker. Which one's functional, which one's symbolic? How much revenue? Check down, if you can't find it, check downstairs in the office, okay? So you're gonna have to convert the 3 years to 36 months, yes. Yeah, that helps. You need, you know, it's 3 years, but 36 months will be a lot more helpful to your answer. Because 3 years is 36 months, right? Yeah. Maybe some brain food. This isn't really brain food. So maybe some brain food would help some of you. Maybe some snacks. All right, some of you are starting to do other things. Which one is the FIP? The first one. The first license, that would be correct. So this one is the FIP, the 100,000, right? You guys all agree? Does it meet the criteria? And so we recognize that at a point in time, which means how much of that are we recognizing? All of it. Okay, so that's a part of my formula here for total revenue. So at a point in time, yes. Okay, so obviously then the symbolic IP would be the other one that was for a total of $90,000, correct? Okay, and how do we recognize that? Over a period of time, right? So it says how much revenue will SAR recognize in 2024. So the assumption is we're talking about December 31st of 2024, right? And when did this thing happen? What date? September 1st. Okay, so if we're recognizing this second license over a period of time, it says 3 years, but we'll do 36 months. And what do you get per month? How much? 2,500. Okay. Yeah, I mean, I did it, but I don't remember if that's right. So I'm not going to do that math in my head. Okay. How many months from September 1 to December 31st? 4 months. So we'll do this, right? It's part of our little calculation here. And so my total revenue, you guys get it right?
Yeah.
Okay, good. Questions? Is everybody clear as to why the first license is the functional and why the second one is the symbolic? Are we okay with that? You understand the differences between the two? Okay. All right, moving on. So again, just to keep reminding you, talking about revenue. When do we recognize revenue? All of these different things we're discussing today, we have to give special consideration. We just kind of lump them under the special issues. They're not always just black and white, like record at a certain time, record overtime. There's some stuff that can maybe change when we record those as revenue. So we already talked a little bit about franchises. Sarah gave me a pretty good definition, but here we have, in a franchise arrangement, a franchisor grants to the franchisee the right to sell the franchisor's products and use its name for a specified time period. So a relative of someone that used to work here owns the Chick-fil-A down in Altoona, and we were kind of familiar as that individual was going through the whole process of acquiring that franchise, going through all the training and stuff. So if you know anybody, it's not as easy as it sounds. It's a heck of a lot of work, and there's a lot of training involved. But anyway, franchises often include a license to use intellectual property, as well as initial sales of products and services transferred at the start of the franchise, as well as ongoing sales over the life of the franchise. The franchisor must evaluate each part of the franchise agreement to identify the performance obligations. So if we go back to our original criteria when we're talking about revenue recognition, it all goes back to performance obligation. And so there's not really an example for this one. It's just to kind of let you know that, hey, there's a lot going on with a franchise. There are different revenue streams. And so you've got to make sure that you're treating each separate revenue stream according to the rules that we discussed for recording at a single point in time or over a period of time. And that's kind of, unless we kind of have a real in-depth example, we don't really go too much further than that. But the franchise does fall under, in part, the license topic that we talked about a couple minutes ago. So we have build and hold arrangements, and this is exactly what it sounds like. A customer buys something from you, you send them a bill, but they don't want to pick it up right away. Okay? They either don't have space for it, or they're not ready for it, whatever the case may be. So we call these build and hold arrangements. So again, the question is, if I sell something to a customer and they pay for it, when do I get to recognize revenue if I still have it in my personal location? Because remember, one of the main criteria we use for determining when revenue is recorded was who has physical possession, right? And the seller still has physical possession in this bill and hold arrangement. So since the customer doesn't have physical possession of the asset until the seller has delivered it, the transfer of control has not occurred. So revenue typically, notice the word typically there, typically should not be recognized until actual delivery to the customer occurs. Why do I stress the word typically? Well, there are exceptions for sure, right? There are exceptions. And that does happen, actually. You would be surprised how often you think, well, somebody paid for this. They didn't come and pick it up? Absolutely. Happens all the time. So again, those are, obviously those exceptions to the rule are individual unique situations that need evaluated separately. Revenue's complicated. It's not as simple as it was in Accounting 101. Sold something to a customer, we recorded our revenue, and that was it. So it's a lot more complex than that now. So I'm not going to have you do any exercises with regards to these. Just be aware, definition, what it is, that it does sometimes create special issues with revenue recognition. So I even hate to talk about this, but here we are. I left it in here just because, it's gonna haunt us forever. Personally, professionally, so many things are going to be ever impacted by the COVID-19, and not just the money that was given out, but even the vaccines and all that good stuff that happened as a result. So I just kind of left this in here so we could just sort of be aware that the COVID vaccine drug manufacturer, they typically view the arrangements to stockpile vaccines as a build and hold arrangement. Now, it says drug manufacturers supply vaccines that the U.S. federal government holds in reserve in its strategic national stockpile in case an epidemic occurs. These could be viewed as build and hold arrangements because delivery to the end user, and that's the person who's receiving the vaccine eventually, is delayed perhaps for years. Just what you want, right? shot of something that's been sitting around in a stockpile somewhere in a warehouse for 4 years or something like that. Sounds like a great idea. What if drug companies stopped manufacturing vaccines because they couldn't recognize revenue for such a long time? Well, we know how the government is. Always a special consideration for them. So under normal circumstances, we would call this a build and hold arrangement, but guess what? The government's special. They need to be able to recognize revenue when they want. So there was, like it says, to avoid this dangerous possibility, the SEC, who's the SEC? The Securities and Exchange Commission, clarified that control of specified vaccine passes to a customer when the vaccine is transferred to the stockpile. So now, think about the drug company. How beneficial is this to them? We make a whole bunch of vaccines, and we're not even sure that they're going to get used, but guess what? We get to still recognize revenue. That's kind of messed up, I think. So, I also am not in charge, so who cares? Who cares what I think, right? So keep reading here. During 2020, COVID-19 was clearly an epidemic, but as pharmaceutical companies scrambled to create vaccines, there was no indication that they would be transferring those vaccines to the strategic national stockpile. So there was significant risk that revenue would need to be deferred. Given that some vaccine production contracts span multiple periods, the amount of revenue to be recognized was difficult to estimate. Just like the money that they handed out is really difficult to determine what everyone did with it. And I say everyone, I mean businesses. Anyway, thus a small part of the havoc caused by COVID-19 related to accounting for revenue. Like I said, wreaking havoc in every way possible in our lives. All right. So consignment arrangements. Somebody, before I even show you what's on this screen, somebody tell me what it means if something is on consignment. You guys learned this in Accounting 101. I know you're saying, well, yeah, that doesn't mean anything. Doesn't mean I remembered it, right?
You are allowing someone else to sell your product.
Yeah, if you're allowing someone else to sell your product for you. So, you know, maybe you've heard of consignment stores, right? Where you go and there's clothing and other, other things that you can buy. Where is that individual getting all those clothes from? Well, people who would like to try to sell their personal belongings, but don't really have the platform to do so. Like, let's say I rent a space and I say, hey, this is a consignment store. You all want to try to sell some of your stuff in my store? I'll give you the space to do that. I'm going to charge you a fee, that's all. So if I sell your outfits, your shoes, whatever, I get to keep a small percentage of that just for letting you have a platform, a marketplace to do your buying and selling, right? That's pretty much what consignment arrangements are. So we've discussed this before in 101. This is pretty straightforward, so the consignor is the person who physically transfers the goods to the other company, the consignee. So like if you guys ever go, and maybe some of you are like, no, we don't go to these things. Like a craft store, like a place that sells, a whole bunch of like decorations and stuff like that. Normally in that store, there's a place, it's at the bottom, I know, I'm going to screw this up because I can't remember. So it's Duncansville, Hollidaysburg area. There's like a big indoor, what do I want to call it? Flea market. That's the word I'm looking for. Okay. You guys know what a flea market is? You guys know what a flea market is. This is an indoor flea market. I forget the name of the place. This big, huge building. And when you go in there, some people might say it's junk, right? One man's junk is another man's treasure or something. One man's trash, that's it, is another man's treasure, right? But you can buy, there's a whole bunch of stuff, but these are all different vendors who have put their stuff in this big place, to try to sell it. So who owns those goods is the question, right? So if I'm not crafty at all, maybe some of you will be not shocked by that, but if I was crafty and I made a bunch of crafts to sell in somebody's store, who owns those goods when I take them down and put them in this person's store? Me or the store owner? Me. They're mine. The store is just a place for me to try to sell them, right? So the consignor, look, first bullet, the consignor, the owner, retains legal title. So I own those crafts, right? If a buyer is found, right? So I have my stuff sitting on there's a place in Bedford too that you can like go buy crafts like that in downtown Bedford. It's a little cute little store. It's actually not little, it's pretty big. But anyway, if the buyer is found, the consignee remits the selling price to the consignor. So you sell my crafts, let's say it's a wreath for 50 bucks, you give me my $50, right? But, you give me all $50? No, because you get a cut of that, right? You get a commission out of that. Because you gave me a place to sell my stuff, where I wouldn't have had otherwise, right? If the consignee can't find a buyer, you usually return the goods to the consignor, right? And so listen, here's the most important part. Given that the consignor retains the risk of ownership, because if it doesn't sell, right? You as the store owner, you got no loss, do you? No, I take it back, and I spent money making it, so I didn't sell it, it's my loss, right? Then we postpone revenue until we can sell it. So I don't get to record revenue till it sells out of your store and you give me the money, okay? All right, so with that, let's take a look at page 320. No, sorry, hold on, I'm missing a page. 319, there's my page. All right, so 29, brief exercise 29. So let's read through it and then I'll give you a minute to think about it. Carrie Ann paints landscapes and in late 2024 placed 4 paintings with a retail price $250 each in the Holmstrom Gallery. You guys ever been to a gallery like that? A bunch of different artwork. Carrie Ann's arrangement with Holmstrom is that Holmstrom will earn a 20% commission on paintings sold to gallery patrons. So patrons would be the people who are in there trying to sell their stuff, right? As of December 31st, 1 painting has been sold by Holmstrom to gallery patrons. How much revenue with respect to these 4 paintings should Carrie Ann recognize in 2024? Take a minute. I'm going to add more questions to this too. I have 2 more questions I'm going to add. Well, if Carrie Ann, if that's her business, if she's in the business of selling paintings, then correct. She would have to obviously keep track of her sales for tax purposes. Yeah, just because she's not employed. They're not suggesting she's employed. Oh. So this is not a hard question. How much revenue should Carrie Ann recognize in 2024? 200 and? How much revenue? I have another question after that. What's the total revenue? 250. Okay, see, I told you I have more questions. The question here is how much revenue? All 250 is revenue, but she does have an expense that she has to pay out of the 250. What is it? Commissions, yes, for how much? 50 bucks. Yeah, so see, you gotta be careful there. You guys were wanting to give me the net sales, right? Gross sales is 250. She has a commission expense of $50, right? Where did we get the $50? $250 times 20% is 50 bucks, right? You agree? So then her net sales would be 200. But the question is, how much revenue? So total revenue is 250, the amount she got for the painting. She does have an expense associated with that. It is commission expense of 50 bucks. So the net revenue would be 200, but that's not what the question asked. Now I have another question for you. How much revenue should Holmstrom recognize? 50, yeah. Because the expense to Carrie Ann is revenue to Holmstrom, right? The $50. You good? Questions? One more thing we got to talk about as far as special issues. Okay? We got to talk about long-term contracts. I mean, I'm sorry, before we talk about long-term contracts, we gotta talk about gift cards. See, my brain was ahead of my mouth. So you guys have all gotten gift cards, right? We talked a little bit about gift cards. You have never gotten a gift card. Okay.
You did mention gift
Yeah,
cards.
gift cards, right? So what happens when I go buy a gift card? Tell me what's happening when I go buy a gift card. Tell me exactly what happens.
You're giving them money so that they can give you a card that you can use for that amount of money later.
Yeah, so I go to a restaurant, I go to a store, I buy a gift card, I pay for the gift card in whatever amount, $50, $100, right? And then I give that gift card to someone who then can go spend that money. On the day that I purchase the gift card, though, is the restaurant or the retailer, they providing me with a product or a service on that day? They're not, right? Let's say I go to a restaurant and I buy a $50 gift card. I don't eat there. Did I get service that day? No, I got the ability to buy or to use a gift card for service in the future. So on the day that I purchase it, is it revenue to the restaurant? What is it? It's a liability. Why is it a liability? Yeah, because now that I have the gift card, that restaurant owes the gift card holder food or drink or whatever it is you bought the gift card for, right? So the sale of gift cards, they're deferred revenue. I don't like the name that, deferred revenue liability. That's stupid. So I prefer call it deferred revenue or call it liability. I just don't like the two words together, okay? But hey, whatever, I'm not the author of the textbook either, so. And then when the gift card is presented, then you move that amount, the $50 or whatever it is, out of the liability account and into a revenue account, right? When the gift card is presented. What about gift cards that don't ever get used? What happens, do you think?
They have a set period of time where they believe that after this period of time is passed, that the gift card will be not likely to be used.
Yeah, so what do we call that date? I call it an expiration date. So when the gift card expires and it hasn't been used, then it gets transferred from the revenue account from the unearned revenue account to the revenue account. Yeah. So, gift cards are pretty straightforward. I think that a lot of restaurants and maybe not much retailers, but I think a lot of smaller restaurants, bars, they don't necessarily understand how that works. And so I have seen personally in working with those types of establishments that people just record them as revenue when the gift card's sold. That's not correct. Because then what might you be doing when the gift card is presented later? Double counting. Yeah, double counting your revenue. So you got to be careful there. So revenue should be recognized when the gift card is redeemed, or the likelihood of redemption is viewed as remote, in which case we come upon that expiration date and we can make that assumption. All right, so one more brief exercise for you for gift cards. Brief exercise 6:30. Yes, Garrett.
Sometimes for like online things, like in-store things online,
Uh-huh.
you use a card and you have like an account. If you have like $1 or $2 and you haven't touched it in like 5 years, they might just.
Yeah, well, usually they have an expiration, or you lose a percentage of the gift card face value as time passes.
No, I meant like on a virtual account
Oh,
where you already redeemed the
I
card
gotcha.
and has money
Yeah.
sitting there. I've
Well,
heard of
hey,
that at
listen,
least.
what do you guys do? I'm glad you brought that up. How many of you have ever had a gift card that had like $1 on it left over, or like some change, and then what do you do with the gift card? Toss it. So think about how many gift cards out there with a few dollars left on them or some change people don't. What does that become for that establishment that issued that
I
card?
saw a figure once that like a restaurant got like a couple $1 billion from just that.
Well, yeah, I mean, that adds up. That's my point. So that money that's not spent, it's revenue. Did you have to give anything for it in exchange? You might think, well, it's $1 or it's under $1, but how many cards out there like that aren't fully used? Lots, okay? All right, so brief exercise 6:30, let's look. Goodbye sells gift cards redeemable for Goodbye products either in store or online. During 2024, Goodbye sold $1 million of gift cards. And 840,000 of the gift cards were redeemed for products. You guys ever have a gift card you just didn't use? Forgot about it? Well, not me, heck no. Anyway, as of December 31st, 2024, $30,000 of the remaining gift cards had passed the date at which Goodbye concludes that the cards will never be redeemed. How much gift card revenue should Goodbye recognize in 2024? Maybe a minute to think about it. Shouldn't need a whole lot of time. And then I have more questions. Who has an answer for me? 870,000, that's correct. So that's pretty straightforward. You got 840,000 of the gift cards were redeemed for products. That's fair. The 30,000 was determined to be past the date. So those get recorded or transferred from liability to revenue at that point as well. So 870,000 is the total. Now you guys should get this question right. What would be the amount, or how much, no, let me try again. What would the $1 million have been recorded at originally? What kind of account? A liability, right? The $1 million would have been a debit to cash, a credit to some liability, unearned revenue, not unearned revenue liability. I don't like that account name, but unearned revenue for $1 million. As the gift cards are presented, we move a portion out of the liability account and into the revenue account. So the question is, how much gift card revenue should be recognized? The total is 870. That's the answer there. Any questions? All right, so I'm going to introduce you to the final topic of this chapter, and then I'm going to do things a little backwards with this. We don't meet again for a week, right? So far away. So I'm not going to get into this a whole lot today, obviously, because I have something else I'm going to have you guys do. But I just at least want to throw it out there a little bit. So long-term contracts. We talked briefly at the beginning of the chapter that sometimes when we have projects, they take longer than the traditional, hey, somebody comes to my store and buys something and I record revenue. And there are two issues that we're going to be looking at. So a long-term contract, the best example I can give you is a construction contract. Buildings, roads, bridges, those sorts of things are not things that happen quickly. They happen over a period of time, right? Sometimes a period of years. And so you have to be able to figure out, well, when do I record revenue? Like, I'm spending all this money, right? If you've got this project like this building, I forget how long it took, let's say almost 2 years. You're forking out all this money over a 2-year period. At what point can I start recognizing revenue?
I can give you an example. It depends on if the contract's if the company doesn't complete it and it's that the company that commissioned it can call another company.
Yeah, that's one situation.
So
yeah.
the other one could do it as it goes along.
Right, that's one situation, absolutely. So we still have the same two options that we talked about at the beginning of the chapter. We can recognize at a point in time, or we can recognize over a period of time. Those are really our only two options in all of the examples that I've given you, but we have to decide which one's most appropriate. And things get a little complicated when it comes to long-term contracts because, listen, if you're a construction company and you're spending all this money building something, you need to bill your customer and collect some money to pay for the expenses that you're incurring along the way. Because we're talking millions and millions of dollars in most cases, right? So a couple of things that we're going to have to really focus on when we talk about long-term contracts is we're going to focus on the performance obligation. And then we're going to focus on when that is satisfied. And those are sometimes things that are not easy to do. And so our choices are going to be, again, we recognize revenue over a period of time as the project is completed. We call that percentage of completion. So if the project's 30% complete, we recognize 30% of revenue at the end of the period. And then another 50% complete, and then another 20%. So we would recognize revenue at 3 different points over a period of time. There's also upon completion. So we wait till the very end to recognize revenue. what I think about and I gave you guys all these PowerPoints, and as I go through them, I'm like, man, they feel like the examples, and I like this book, but I feel like the examples that are associated with this are super complicated. So when we come back on next Thursday, what I'm going to do is I'm actually going to do 2 brief exercises before I get into the details, because I feel like the exercises are very clear as to how it works. Then we'll kind of back into some of the information with regards to each of those examples of percentage of completion or completed contract. So that's all I wanted to say about that. So what I want you guys to do though for me now is get your laptops out. If you didn't bring it, share with a friend. And we're going to turn to page 335. That is our target case. Now again, all these things we talk about, it's like we like to see them in real life. And I didn't go into any detail about how companies disclose information on revenue. But here you're going to get an example just to put it into practice. It's even better that way. So you guys need to go and listen to me carefully. We've done this before. We have looked at the 2019 annual report for Target. Go to Google and just search it. 2019 Target annual report. Or Target 2019 annual report. Maybe that's the way I should have worded it. It says, Target Corporation prepares its financial statements according to GAAP. Target's financial statements and disclosure notes for the year ended February 1st, 2020. Why am I telling you 2019? Because that's the 2019 annual report. It runs from February 2nd of 2019 to February 1st of 2020. I know those are weird dates, but it just does. Okay? It says they're available in Connect. We're not using Connect. We got the internet, so you might as well just go out there and find it. Now it says, this material is also available under the investor relations link at the company's website. So you could go to target.com, scroll all the way to the bottom, click on investor relations and find it that way. In any event, you need to go and look at the disclosure notes. Do you guys remember how to do that? Before I have you actually do it here? Somebody tell me once you get to that report. Under which, hold on, I'm getting there myself. You want the 2019 annual report. Somebody tell me under what section tell me what part and what item I'm going to find the disclosure notes. Nobody knows? You guys should know this. You've been there before. It's not the first time. It's not your first rodeo here, people. How about, let me give you a hint. How about item 8? You guys remember item 8? So item 8 starts off with all of your consolidated reports and then what follows them. You guys can read, right? The notes to the consolidated financial statements, right? Right underneath. So you want item 8 is where you're going to be looking, I'm assuming for most of these questions. I looked at this earlier. Yep. So, can you guys look up on my screen, please? Look. Note 1, Note 2, Note 3, Note 4. If you go to the assignment, it tells you exactly what note to look at to find your question, your answer. Disclosure Note 2, Disclosure Note 2, 4, right? So I want you to answer these 5 questions for me. You can work in a group. Everybody does their own answers though. I'll put a link in Canvas for you to upload, and I am going to grade this case. So now we're taking what we've talked about so far in terms of revenue, And actually, you don't have to worry about long-term contracts here for this one, I don't believe. But answer the questions, that's all you gotta do. And you got 15 minutes left, so you need to work on that now. Nobody's leaving. Have another snack while you're working. Everybody know what they're doing? Yes? Okay. So I'm gonna put a link in there for you so you can upload it. Now, I said I wasn't gonna give you homework, I meant it. If you don't get this done today, it's not due until next Thursday, right? Okay. This one's, these cases, I usually make these worth points and not just a check mark, so this one's 15 points, just so you know. You can upload a file, you can type right in the assignment, I don't care, whichever one is easier for you. So this will be due the 12th at 11, right before class and no later. You got a whole week to answer 5 questions. Does anyone have any questions?